Stop scrolling right now, close that other tab. Whatever you are about to do in the next 12 minutes can wait, because what I'm about to show you is the single most important piece of financial information you will hear this entire week. The silver price you're seeing on your screen right now, the one showing $80 and change, that number is a lie. Not an exaggeration, not a pessimistic forecast, a mathematical, provable, documentable lie. And I have the receipts. This is finance currency, and today we're pulling back the curtain on the largest precious metals deception in modern financial history. Before you click away thinking this is another conspiracy video, let me show you 3 pieces of data. Not opinions, not predictions, documented facts published in the last 72 hours that prove beyond any reasonable doubt that the silver market you think exists does not actually exist anymore. Fact 1. As of this morning, the official COMEX silver warehouse inventory shows that 200 million ounces of physical silver have vanished from the exchange system since the middle of last year. 200 million ounces. At today's fake price of $80, that's $16 billion of metal that was sitting in vaults 9 months ago and is completely gone today. Fact 2. India, the single largest silver buying nation on planet Earth, has completely frozen all new silver imports. Not reduced them, not slowed them, frozen. The Indian government has suspended the authorization process that allows banks to place new import orders for silver from overseas suppliers. The pipeline is dark, and according to supply chain reports published just yesterday, domestic shortages are beginning to form. Fact 3. In Shanghai, the world's largest physical precious metals exchange, real buyers paying real money for real silver are paying $93 per ounce this morning. Not 80, 93. That's a $13 premium over the price being printed on your screen in New York. Now before we go any further, I need to ask you something, and I actually want you to do this. Pause for just 2 seconds and drop a comment right now telling me where in the world you're watching this video from and what time it is where you are. Are you watching this from New York, London, Mumbai, Sydney? What time zone are you in? Because what I'm about to explain affects every single geography differently, and I want to know where finance currency viewers are positioned on the map. Go ahead, comment right now, then come right back. Here's what's actually happening, and why the $80 price is a fiction. For decades, the silver price has been set by paper trading, futures contracts, derivatives, financial instruments that represent claims on silver but are not themselves silver. The vast majority of silver trading happens in this paper market. It's fast, it's liquid, it's leveraged, and most importantly, it requires almost no physical metal to actually change hands. But over the past 9 months, something has fundamentally broken in that system. The paper market and the physical market have begun to diverge. And when I say diverge, I don't mean a little bit. I mean they're living in 2 completely different realities right now. The paper market, the one in New York, says silver is worth $80. The physical market, the one where actual metal has to be delivered to actual buyers, is saying something completely different. And that $13 gap between New York's 80 and Shanghai's 93 is not noise. It's not a temporary dislocation. It is a flashing red alarm signal that the pricing mechanism the entire world has relied on for 50 years is failing in real time. Let's start with those 200 million ounces that have disappeared from COMEX warehouses. COMEX, the commodity exchange in New York, is where the official futures price of silver gets set. It's the benchmark, the global reference point. And within the COMEX system, there are warehouses where physical silver bars are stored. These warehouses serve as the backing for the futures contracts being traded. In a healthy market, warehouse inventory should be relatively stable. It goes up a little, it goes down a little, but it generally hovers around an equilibrium because the futures market and the physical market are in balance. That is not what's happening. Since the middle of 2025, COMEX warehouse stocks have been in freefall. We're not talking about normal fluctuations. We're talking about a sustained, relentless, one-directional drain of physical metal out of the system. 200 million ounces net withdrawn, gone, delivered out, not coming back. At the current rate of withdrawal, COMEX warehouses will hit critically low levels within months. Some analysts are saying weeks. And when I say critically low, I mean low enough that the exchange may not have sufficient physical inventory to cover delivery demands against outstanding contracts. Now, you might be thinking, okay, but maybe that just means people are buying silver and taking delivery. Isn't that normal? Yes, taking delivery is normal. What's not normal is the scale, the speed, and the fact that it's happening while the price is barely moving. Think about that for a second. $16 billion of physical metal has left the warehouses in 9 months, and the price has gone from the mid-70s to $80. That's a move of maybe 6-7%, while a fifth of the available inventory has vanished. In any functioning market, when supply disappears at that rate, prices explode. They don't drift up 6%. They gap higher, sometimes violently, because scarcity creates competition, and competition drives price. The fact that the price is not exploding tells you one thing with absolute certainty. The price is not being set by physical supply and demand anymore. It's being set by something else. And that something else is paper contracts that have no intention of ever delivering metal. Now let's talk about India, because this is where the story goes from concerning to critical. India is not just a big silver buyer. India is the biggest silver buyer in the world. Indian households, businesses, and financial institutions purchase more silver annually than any other country on earth. It's cultural, it's industrial, and as of April 1st of this year, it's now officially financial. On April 1st, India implemented new banking regulations that allow Indian citizens to use physical silver as collateral for loans. Read that again. Silver is now monetized within the Indian banking system. You can walk into a bank in Mumbai with silver bars and borrow money against them just like you would with gold or real estate. This is a massive structural upgrade to silver's role in the second most populous country on the planet. It's not a temporary trend, it's policy, it's permanent, and it creates a whole new category of demand that did not exist 6 months ago. At the exact same time this new demand infrastructure is being built, India's import pipeline has gone completely dark. The Indian government has frozen the authorization process for new silver imports. Banks cannot place new orders. Shipments that were scheduled are on hold. The flow of metal into the country has stopped. Now publicly, this is being described as a bureaucratic delay, paperwork, administrative processing, nothing to worry about. But supply chain sources on the ground are telling a very different story. They're reporting that domestic inventories are running low. Dealers in major cities are struggling to source metal, and the longer this freeze lasts, the closer India gets to an actual physical shortage in the largest silver market in the world. Do you understand what that means? The country that buys more silver than anyone else just upgraded silver to official financial collateral status and simultaneously cut off its own supply pipeline. Demand is about to spike structurally, and supply is frozen. That is not a recipe for $80 silver. That is a recipe for a price that makes $80 look like a distant memory. But here's where it gets even stranger, because while COMEX is draining and India is frozen, there's a third piece of this puzzle that proves the $80 price is completely detached from reality. And it's happening right now, in real time, in the Shanghai market. This morning, physical silver on the Shanghai Gold Exchange, the largest physical precious metals exchange in the world, is trading at $93 per ounce, not $80. That's a $13 premium. $13 more than the price being printed in New York. And before you say, well, maybe that's just shipping costs or taxes, let me stop you right there because it's not. In a normal functioning market, arbitrage closes price gaps almost instantly. If silver is $80 in New York and $93 in Shanghai, arbitrageurs should be buying in New York, shipping the metal to Shanghai, and selling at $93. They pocket the $13 spread, and in doing so they force the prices back together. New York goes up, Shanghai comes down, the gap closes. That's how markets are supposed to work. Price differences create profit opportunities, and profit-seeking traders eliminate those differences, except that's not happening. The Shanghai premium has been elevated for months. It's not a one-day anomaly. It's a sustained structural condition. The gap widens, it narrows slightly, but it never closes. And the reason it never closes is because the arbitrage mechanism is broken. Why? Because there is not enough physical silver available in the West to ship to the East to close the gap. The metal that would be required to move from New York to Shanghai to equalize prices does not exist in sufficient quantity, or it's not available for sale at anywhere near $80. The Shanghai premium is the market screaming at you that the paper price in New York is fake. It's telling you that real buyers using real money in the real world value silver at least $13 higher than the paper market admits. Let me explain why this is so significant, because this is the part that separates people who understand markets from people who just watch numbers go up and down. When two markets for the same asset price that asset differently, one of three things is true. 1. There's a temporary logistics issue preventing arbitrage. Maybe shipping is disrupted. Maybe there's a regulatory barrier. These gaps usually resolve in days. 2. One of the markets is mispricing the asset due to lack of information or liquidity. This also resolves quickly as information spreads. 3. The two markets are not actually trading the same thing anymore. We are in scenario 3. The paper market in New York is trading contracts, promises, financial instruments that reference silver but are settled overwhelmingly in cash, not metal. The physical market in Shanghai is trading actual silver, bars, metal that has to be delivered, stored, and secured. Those are not the same product, and the $13 gap is the price of that difference. When you buy a futures contract in New York, you're buying exposure to silver price movement. When you buy silver in Shanghai, you're buying silver, and the market is telling you that the second thing is worth $13 more per ounce than the first thing. Now, if you're holding paper silver, whether that's ETFs, futures, or any other derivative instrument, you need to understand what that gap means for you. It means that in a scenario where physical supply becomes scarce, where delivery demands exceed available inventory, your paper claim is not going to convert to metal at the paper price. You're going to get settled in cash, at whatever price the institution decides is fair, or you're going to be told that physical delivery is suspended due to extraordinary market conditions. The contract you're holding has force majeure clauses, it has cash settlement provisions, it has escape hatches built in for exactly this kind of scenario. The Shanghai premium is advance notice that those clauses are going to be invoked. Now there's another force pressing on this market that's completely external to supply and demand fundamentals, but it's amplifying everything we've just discussed. Geopolitical instability is at levels most of us have never seen in our lifetimes, and when nations stop trusting each other, they stop trusting each other's currencies. As of this weekend, the Strait of Hormuz, one of the world's most critical energy choke points, is effectively closed. Iranian military forces have engaged shipping in the region, and the United States has announced it's prepared to board Iran-linked vessels globally. Roughly 20% of global oil supply moves through the Strait of Hormuz. If that supply is disrupted for any meaningful length of time, energy prices spike, inflation accelerates, and the safe haven bid for hard assets intensifies dramatically. Now, I'm not going to speculate on how that situation resolves. Nobody knows. But what I can tell you is this. Every single hour that the strait remains contested, the premium commanded by physical precious metals increases, because uncertainty is the fuel that drives safe haven flows. And silver, sitting at the intersection of monetary hedge and industrial necessity, captures both sides of that demand. At the same time, central banks around the world are continuing to diversify away from dollar-denominated reserves. Brazil, just in the past year, doubled its gold reserves as a percentage of total holdings. The Bank of Central do Brasil increased gold from 3.5% of reserves to over 7%. Brazil is not an isolated case. Central banks collectively now hold more gold than US dollars and treasuries combined for the first time since the early 1970s. The early 1970s. Does that time frame sound familiar? Because it should. That was the period immediately before gold and silver broke free from suppressed price structures and went parabolic. Silver went from under $150 per ounce to $50 within a decade, a move of more than 33 times. We are watching the same structural setup occur right now, not in hindsight, right now. Before we go further, I need you to do something for me. If this information is making sense, if the pieces are clicking into place for you, hit that subscribe button right now. Because Finance Currency is one of the only channels tracking this story in real time with actual data, not hype, not speculation, but documented evidence. And drop another comment. Tell me, are you holding physical silver right now, or are you in paper? ETFs, futures, mining stocks? I want to know where the Finance Currency audience is positioned, because what I'm about to explain next is going to determine whether your position survives what's coming. We've covered the COMEX drain, we've covered the India freeze, we've covered the Shanghai premium, but there's one more piece of this puzzle that ties everything together, and it's the scariest part of all. It's the mechanism behind the price, the spoofing, the manipulation, and the institutional desperation that happens every single time silver approaches a breakout level. Let me show you exactly how this works, because once you see it, you can't unsee it. Last Friday, April 17th, silver was trading at approximately $82.50 during the New York session. The market was strong, volume was healthy, and the price was pushing toward the critical resistance level at $83.17. Then at exactly 12:07 p.m. Eastern Time, a single massive red candle appeared on the chart. In 18 minutes from 12:07 to 12:25, silver dropped nearly $4. 18 minutes, $4 drop. On no news, no economic data release, no Fed announcement, nothing. And this happened less than 3 hours before the New York Mercantile Exchange monthly options expiration. Here's what actually occurred, and this is not speculation. This is a technique called spoofing, and there are criminal convictions of precious metals traders for doing exactly this. Spoofing works like this. A large institutional trader floods the order book with massive sell orders at prices just above the current market level. These are not real orders. The trader has no intention of actually executing them. They're fake. But retail traders and algorithmic trading systems can't tell the difference. They see what looks like an enormous wall of selling pressure. They interpret it as major sellers entering the market, and they react by front-running that perceived selling. They sell their own positions to get out before the big sellers drive the price lower. Price drops, fast. And then, after the price has fallen, the original spoofer cancels all those fake sell orders. They were never executed. They were just there to create the illusion of selling pressure. The spoofer either pockets the artificial move or uses the manufactured decline to cover short positions at a better price. This is not a conspiracy theory. This is not basement speculation. Courts of law have convicted traders of doing this in the silver market. The legal precedent exists. The documented history exists. And it happened again last Friday at 12:07. So why does this keep happening? Why do institutions bother manipulating a market this aggressively? Because they're trapped. The large commercial traders, the bullion banks, the market makers in the silver futures market carry massive net short positions. They have sold paper promises to deliver silver that they do not have. And they've done this for years, betting that they could buy those contracts back at lower prices later. That strategy works beautifully in a market where supply is abundant and demand is weak. You sell high, buy back low, pocket the spread, easy money. But we're not in that market anymore. Supply is not abundant. 200 million ounces are gone from COMEX. Demand is not weak. India just monetized silver nationally, and the shorts are underwater. Every single dollar that silver rises, those short positions bleed. At $80, the pain is manageable. At 90, it's significant. At a 100, it's catastrophic. So what do you do if you're an institution holding a giant short position in a rising market? You can't just buy back your contracts openly. That would drive prices even higher and increase your losses on every contract you haven't covered yet. You need sellers, you need liquidity, you need retail traders to panic and sell to you. And how do you create sellers? You manufacture fear. You publish research notes telling clients to reduce exposure, take profits, exercise caution. You create volatility spikes like the one on Friday at 12:07. You shake the tree until weak hands fall out. When you see a research note from a major bank this week saying silver looks overbought, consider trimming positions. Don't read that as a forecast. Read it as procurement. They need you to sell. They need your metal. And they're using every psychological and technical tool available to make that happen. Here's what you need to watch in the days ahead, because the price action around these levels will tell you everything. On the upside, resistance sits at 83.17. That was Friday's session high. If silver breaks above that level and holds, the algorithmic trend-following systems trigger. Billions of dollars of systematic buying power enters the market. The breakout becomes self-reinforcing. The institutions know this. That's why Friday's 12:07 sell-off happened exactly when it did. They were defending 83.17 because losing that level changes the entire character of the market. On the downside, support is in the 77 to 78 range. That was this week's intraday low. If a flush is attempted early this week, that's the target. They'll try to trigger stop-loss orders just below that level to create cascading automated selling. But here's the critical difference between now and every other time they've attempted this playbook. The structural defense is different this time. India's institutional demand is activating. Chinese buyers are paying $13 premiums. 6 years of supply deficits have depleted the inventory buffer that used to absorb these shakeouts. The buyers waiting below the market are not speculative retail traders using margin. They're industrial operators with procurement budgets. They're sovereign wealth allocators. They're Indian banks building loan collateral inventories. Those buyers don't have stop losses, they have purchase orders, and every manufactured dip gets absorbed faster than the last one. Now let me show you why this situation is completely different from any previous silver rally and why the traditional tools for killing precious metals momentum don't work anymore. In 1979, when gold and silver were running, the Federal Reserve raised interest rates to 18%. 18%. That brutally high interest rate broke the inflation cycle and killed the precious metals rally. It was painful. It caused a recession. But it worked. That option does not exist today. The United States currently carries over $34 trillion in national debt. At an average interest rate of just 5%, the annual interest expense on that debt is nearly $2 trillion. That's approaching 40% of total federal tax revenue just to service the debt. If the Fed tried to raise rates to 10%, let alone 18%, the annual interest cost would be $3.5 trillion, more than total income tax receipts. The government would be mathematically unable to pay its bills. This is what economists call fiscal dominance. The debt load is so large that it constrains monetary policy. The Fed cannot raise rates high enough to fight inflation without collapsing the government's fiscal position. What that creates is a negative real interest rate environment for as far as the eye can see. The interest rate you earn on savings is structurally lower than the inflation rate. Your purchasing power is being destroyed in paper assets, and when that happens, capital seeks hard assets. Gold, silver, real estate, commodities, anything that holds value when currency is being debased. This is not a 3-month trade. This is a structural regime that could last years, maybe a decade. And silver sits at the exact intersection of that monetary crisis and an industrial supply crisis happening simultaneously. Alright, if you're still with me, you now understand more about what's actually happening in the silver market than 99% of people watching financial news right now. So here's what I need you to do. Subscribe to Finance Currency if you haven't already. Because this story is not over, it's just beginning. And I'm going to be tracking every single data point, every warehouse update, every Shanghai premium shift as this unfolds. And comment below. Tell me, do you think the $80 price holds through this week? Do you think we see a breakout above 83? Or do they attempt another flush down to 77? I want to hear what the finance currency community thinks is coming next. We've covered the deception, the arbitrage, and the manipulation. But there's one final question we need to answer. What do you actually do with this information? Because understanding the problem is one thing, positioning yourself correctly is something else entirely. Let me be extremely clear about something that most people do not fully understand until it's too late. There is a fundamental difference between owning silver and having exposure to silver. Paper instruments give you exposure. ETFs, futures contracts, mining stocks, certificates, pool accounts, all of these give you price exposure. When silver goes up, your account value goes up. When silver goes down, your account value goes down. But exposure is not ownership. Ownership means you possess the physical metal. It's in a vault with your name on it, or it's in a safe in your house. There is no intermediary. There is no counterparty. There is no institution standing between you and the asset. And in a scenario where the pricing mechanism fractures, where delivery demands exceed available supply, where force majeure is invoked and cash settlement is imposed, that distinction becomes everything. Let me give you a concrete example of what I mean. Right now, one of the largest silver ETFs in the world holds hundreds of millions of ounces of silver in trust for its shareholders. On paper, if you own shares of that ETF, you own a proportional claim on that silver. But go read the prospectus, actually read it. Buried in the legal language, you'll find clauses that allow the fund to suspend redemptions under extraordinary market conditions. You'll find force majeure provisions. You'll find cash settlement options. What that means in plain English is this: if the physical silver market dislocates badly enough, you will not be able to convert your ETF shares into physical metal. You'll be paid cash, at whatever price the fund decides reflects fair value at the time of settlement. Now maybe that price is fair, maybe it's close to the real physical market price, or maybe it's the paper price, the fake $80 number. While physical silver is trading at 110 in Shanghai, you don't get to choose. You don't get to negotiate. The terms are already written in the contract you agreed to when you bought the shares. India understands this. That's why Indian banking regulations now recognize physical silver as loan collateral, not ETF shares. Physical, metal you can touch. China understands this. That's why Chinese households hold an estimated 60,000 metric tons of gold in private hands, not their government, not their central banks, private households, because generational experience taught them that paper claims fail when systems are under stress. I want to take you back to the 1970s for a minute, because the parallels to today are not just similar, they're almost identical. The early 70s were characterized by stagflation, an energy crisis, and a collapse of confidence in government-backed currency. The US had just abandoned the gold standard. Inflation was accelerating, trust in the dollar was eroding, and precious metals exploded. Silver went from approximately $1.30 per ounce in 1971 to $50 per ounce in 1980. That's a move of nearly 40 times in less than a decade. Gold went from $35 to over $800, 22 times. Now, the common narrative about that rally is that it was a speculative bubble driven by attempts to corner the silver market. And there's some truth to that for the final parabolic spike. But the foundational move, the run from $130 to $20 to $30, that wasn't speculation. That was a monetary crisis expressing itself in hard asset prices. And here's the critical part. The conditions today are not just similar to the 70s, they're worse. In the 70s, US national debt was under $1 trillion. Today it's $34 trillion. In the 70s, the Fed could raise rates to 18% to break inflation. Today, raising rates to even 8% would make the debt unsustainable. In the 70s, global supply chains were simpler and more resilient. Today, they're complex, fragile, and geopolitically exposed. And in the 70s, China and India were not yet the dominant manufacturing and consumption powers they are today. Every structural factor that drove silver from 130 to 50 in the 70s exists today in amplified form, and this time there's no option to stop it with rate hikes. Let's talk about supply, because this is the part of the story that makes the coming move inevitable, not speculative. The Silver Institute, the official industry body, not a newsletter, not a blog, the actual institutional authority on silver supply and demand, has documented 6 consecutive years of structural supply deficit, 6 years where global demand exceeded global supply, 6 years of drawing down above-ground inventories, and according to their own data, there is no return to equilibrium in sight. Mine production is not ramping. It's growing modestly, but nowhere near fast enough to close the deficit. Recycling is constrained, and there are no major new silver mining projects coming online in the near term. Why? Because for over a decade, from roughly 2011 to 2020, silver prices were suppressed in the $20 to $30 range. At those prices, new mining projects were not economically viable. Nobody funded exploration, nobody drilled, nobody developed new deposits. That decade of underinvestment is now locking in scarcity for the next 5 to 10 years. Because even if silver hits $150 tomorrow and every mining company on Earth decides to build new mines, those projects take 5 to 7 years to come online. The supply response is years away. The deficit is happening right now. And the only mechanism the market has available to balance supply and demand in the short term is price. That's the only way demand comes down fast enough to match available supply. But here's the problem. Most industrial silver demand is inelastic. Solar panels need silver. EV components need silver. These are not discretionary uses that disappear when price rises 10 or 20%. The price level required to actually destroy meaningful industrial demand is dramatically higher than $80. Some estimates put it at 150 to 200 before substitution becomes widespread. So let's map out what the next 6 to 12 months could look like based on everything we've covered. Scenario 1. The freeze breaks and equilibrium restores. India's import authorization resumes. COMEX inventories stabilize. The Shanghai premium normalizes. Price volatility decreases and silver settles into a range. Probability low. Because the structural deficit is 6 years deep, and the new demand infrastructure in India is permanent policy, not a temporary condition. Scenario 2. Managed descent. Price rises in a controlled manner. Institutions manage their short exposure carefully. Volatility remains elevated, but not disorderly. Silver moves from 80 to 100 to 120 over 12 months. Probability, moderate. This requires cooperation among major players and no external shocks. Possible but fragile. Scenario 3. Disorderly breakout. A catalyst triggers a rapid move higher. Could be a delivery failure at COMEX. Could be India announcing emergency domestic procurement measures. Could be a geopolitical event that sends safe haven flows vertical. Price gaps through resistance levels. Algorithmic systems trigger. Institutional short covering creates a feedback loop. Silver moves $30, $40, $50 in a matter of weeks. Probability higher than most people think. Because all the structural conditions are already in place, it just needs a match. Scenario 4. Full dislocation. The paper and physical markets separate entirely. COMEX invokes force majeure and suspends physical delivery. Cash settlement is imposed. The paper price freezes or collapses while the physical market continues trading at massively higher levels. ETF holders get cashed out at paper prices. So what do you actually do with this information? First, understand your position. If you hold paper silver, understand the counterparty risk you're carrying. If you hold physical silver, understand that you're holding the asset that matters in a dislocation scenario. Don't sell into manufactured volatility. Don't let spoofed price drops shake you out of a position in the most structurally tight market in decades. Second, watch the levels. 83.17 on the upside, 77 on the downside. How price behaves at those levels will tell you whether institutions are still in control or whether the breakout is beginning. Third, pay attention to the data, not the headlines. COMEX inventory updates come out weekly. Shanghai premiums are published daily. India's import situation will eventually resolve one way or another. And fourth, recognize that this is not a 3-month trade. This is a structural revaluation that could take years to fully play out. Position accordingly. Don't use leverage. Don't trade in and out trying to catch every swing. If the thesis is right, the destination matters more than the path. All right, we've covered 4,000 words. We've gone deep into the COMEX drain, the India freeze, the Shanghai premium, the manipulation tactics, the fiscal trap, and the supply deficit. If you made it all the way to the end, you're now in the top 1% of informed people on this topic. You understand what's actually happening while the rest of the world is watching fake prices on a screen. So here's what I need from you. 1. Subscribe to Finance Currency. This story is unfolding in real time, and I'm tracking every single development. 2. Drop a comment and tell me where you stand. Are you in physical, paper? Are you waiting for a pullback, or are you buying at these levels? And don't forget, tell me where in the world you're watching from and what time it is. I want to know where the Finance Currency global audience is positioned. 3. Share this video, because most people have no idea this is happening, and the people who figure it out first are the ones who position correctly. The $80 silver price is fake. 200 million ounces are gone. India is frozen. Shanghai is paying 93. The question is not whether this resolves. The question is whether you're ready when it does. This is Finance Currency. I'll see you in the next one.